Hello to everyone. I am Nicolas, Bornozis, President of Capital Link, and I would like to welcome you to Capital Link's Trending News webinar series. It is our pleasure to welcome today Mr. Zacho, the CEO of Navigator Gas. Navigator Gas is the owner and operator of the world's largest fleet of handysize liquefied gas carriers and a global leader in the seaborne transportation services of petrochemical gases such as ethylene and ethane, liquefied petroleum gas, LPG, and ammonia. Also, Navigator Gas owns a 50% share through a joint venture in an ethylene export marine terminal at Morgan's Point in Texas on the Houston Ship Channel in the United States. The company plays a vital role in the liquefied gas supply chain for energy companies, industrial consumers, and commodity traders, providing an efficient and reliable floating pipeline between the parties. Navigator Gas common shares trade on the New York Stock Exchange under the ticker symbol NVGS. Now, before we begin, I'd like to mention the usual disclaimer. Please note that this discussion is for information and educational purposes only. It should not be considered investment advice or advice of any kind or an offer to buy or sell any securities. And as an additional disclosure, we are proud to work with Navigator Gas on investor relations. Mats, thank you for joining us today again. Since our last discussion in March, there have been several important developments for Navigator Gas, key building blocks that continue to shape the company's future. So today, we look forward to gaining insight into market trends, recent company updates, and the broader strategic direction for Navigator, as well as the significant developments in the overall energy market in the US and globally. So let's start our discussion. We are hosting today's webinar after your earnings conference call yesterday. You had great results. Is there anything that you would like to expand or emphasize today regarding the financial results or strategic priorities for the year? Anything that you want to highlight following yesterday's call?
Yeah, sure. Thanks a lot, Nick. And yeah, good to be with you again for this discussion. And you said it yourself, a lot has changed since we talked the last time here. The world around us has definitely been very, very dynamic. So it's a great pleasure that we can present a Q1 result that is strong. I think two things spring to mind here in terms of highlighting some of what happened. I think Q1 was really a great example of the resilience of Navigator. I mean, the ethylene exports from the US was weak. The output from the terminal was low, but despite this, we posted record operating revenue as a company during the quarter. I mean, the terminal earnings were negative for the first time since Q1 of 21, and yet we posted one of the highest quarterly EPS numbers in the past 10 years. So you can say I'm very pleased with the results for Q1. It was difficult circumstances, but despite this, we showed the resilience and demonstrated or showed a really nice Q1 result. So that's one thing. And maybe the other one I want to mention is that Navigator is not a bet on China. I mean, our China exposure is reasonably limited. Over the past 5 years, about 10% of the ethylene exported through Morgan's Point went to China. So I think we've demonstrated here and just want to remind everybody that Navigator is a bet on America. And I'm quite pleased with that.
So thank you. Going to the next question. Given the recent volatility in tariffs and trade flows, what is your outlook for the global seaborne transportation for gas, petrochemicals, for the market over the next 6 to 12 months?
Yeah, I mean, visibility right now is probably not the same as it was, let's say, half a year or a year ago. I'd say anyway that the business climate just went from highly uncertain to something that's slightly less so. I think it's too early to declare that the trade war is over. So visibility is clearly lower than normal. I think the risk of a global recession has clearly decreased since early April, but there's still a risk that the global growth is going to decline. That said, I think we expect that the demand growth for petrochemicals will stay high over the next couple of years. We'll see underlying global demand for petrochemical commodities. We have the US export capacity that is expanding and will continue to expand over the next couple of years. And the US petrochemicals are highly cost competitive, unless, of course, high tariffs are being imposed by importing countries. But in the absence of high tariffs on US petrochemicals, we expect them to grow quite significantly. So I think the overall demand picture is quite good.
In the overall petrochemical gas mix, how do you see this mix developing among the various petrochemical gases in terms of market outlook?
Yeah, I think particularly for the petrochemicals like ethylene and ethane, we see strong infrastructure built out in the US and strong demand globally. So we expect to see continued robust demand for those. The LPG trade has also been stronger, you could say. Recently, you can see the VLGC rates have stayed quite resilient in the past couple of weeks. And our outlook, you could say, for LPG demand is quite good. We've seen a little bit of a weakening in the ammonia market, where there's been some, you could say, negative impact from, you could say, lower rates in the MGC market. So on that aspect, you could say a little bit of a weakness. But generally, in 80–90% of our business, the demand picture is good for petrochemicals and for LPG.
And as I recall from your presentation, your vessels are not subject really to significant USTR fees.
That's correct. For two reasons. First of all, because of the size. So the port fees, they are for vessels that have more than 55,000 tons of dead weight, and all our fleet is below that. And I think more importantly, our ships normally arrive in ballast. We are exporting commodity from the US, and that means that all ships that are exporting from the US are not subject to the port fees, and that means that we are off the hook. So yeah, it seems like we will not be impacted by those port fees. But again, this is subject to change, and we'll see how the final wording of the legislation comes out.
So let me go to the next question regarding the ethylene export terminal. After
Yes.
a relatively low throughput at your ethylene export terminal in the first quarter of 25, you mentioned that throughput volumes increased in April, and you are expecting even more in May. So can you discuss a little bit further? You also mentioned that renewed interest in offtake contracts at the ethylene export terminal are in progress. So can you share your expectations or outlook around securing longer-term volumes?
Yeah, I can. If we look at Q1, it was a weak quarter in terms of the throughput on the terminal. It was weak also compared to the soft Q4 even of last year. So with 86,000 tons for the quarter overall, I mean, that compares to a capacity of 125,000 tons per month. So it's a quite significant weakening that we saw in Q1. And the reason was that the US crackers were under turnaround, and that led to reduced US domestic supply of ethylene, and that led to higher US domestic prices. And for that reason, the arbitrage was narrowing between the US-based ethylene price and the landed price in Europe and Asia. So there was not much ethylene being moved. Now we expect that this volume will return to levels above 110,000 tons in May, which is more than, you could say, all of Q1 and much closer to the capacity of the terminal. So we see this as a normalization, you could say, a return to that demand pattern that we've seen historically. I think on top of this, we can also say that we expect to book some income in Q2 for deficiency payments that relate to that shortfall that we saw in Q1, because these are take-or-pay contracts, and if the volumes are not being taken, there will be a deficiency payment, and we'll benefit from that in Q2 as well. When it comes to offtake contracts, those discussions are proceeding right now. They are, of course, now becoming much more tangible with the ethylene arbitrage opening. I guess you could imagine that over the past, I think pretty much since October of last year, when the arbitrage has been pretty pretty much closed, those discussions have not been so active. But that's definitely changing now with much more spot activity and much more demand for the transportation. So we expect that more offtake will be committed over the next few months, and we're still aiming to fill about 90% of the capacity with multi-year offtake contracts.
Great. So now let me turn over to your customer base, to your customer diversification.
Yeah.
You have a very diverse customer base. And how does this diversification of your customer base and your trading capability help Navigator weather disruptions like the one that we saw in April? Is this structure a key differentiator in today's energy landscape for your company?
Yeah, I think so. I think it is a particular strength for Navigator. We have, you could say, 30, 40 large customers, and they are pretty much the who is who in petrochemicals, in energy, in trading globally. And we are trading our fleet globally, so we can adapt and position the vessels to where the demand is. In Q1, the terminal throughput was weak, and yet we delivered record operating income. So, I mean, the handysize fully ref market was weak because of a dull MGC market, yet our semi-refs and the ethylene vessels performed very well. April was pretty weak across the board, but the contract cover that we have, where we have about 41% of our next 12 months covered, that also helped a lot. So you can see we have pockets of resilience in different parts of our fleet, so that when we see weakness one place, we can rely on other parts doing better. Both our semi-refs and our ethylene vessels right now, they are back with robust demand. So I think that consistency in our cash flow generation is a particular strength for Navigator in an otherwise pretty cyclical shipping industry.
Matt, you mentioned about the charter cover, so that brings me to the next question about your chartering strategy, how you position your fleet amid the market volatility. How are you adjusting your chartering strategy, spot versus time charter, given what is happening in the energy market today?
Yeah. As mentioned, we have about 40%, just over 40% of next 12 months earnings days fixed at about $31,000 per day. So that's a good background to have. It's probably a little bit light. I think probably between 40 and 50% is comfortable and where we want to be. With the growing proportion in our business of petrochemical customers, this market is typically a spot market. So it will require quite some effort, you could say, to bring up the cover. And we do want some spot exposure at the same time, I think, especially in the ethane and ethylene market, I think, where we have very solid market positions. I think here the reward for taking spot positions are higher. I think fundamentally, when you look at Navigator, we have higher operational risk and lower financial risk. So some spot exposure is probably why I see the investors buying into the Navigator stock. So we don't want much financial risk. I think investors can find that much more efficiently elsewhere. But the operational risk, you could say, on operating in an ethane and ethylene market is where we want to be and where we get rewarded for having some open market exposure.
Thank you. I'll go to the financial activities in a minute, but let me, for the moment, focus on fleet renewal priorities. You've acquired 3 second-hand ethylene-capable vessels, and you sold the 25-year-old Navigator Venus. So can
Yeah.
you walk us through how fleet renewal supports both your commercial flexibility and your overall green shipping emission reduction goals?
Yeah. Once our vessels reach 25 years of age, they are harder for us to trade in the global trades that we are operating in and with the customer base that we are having. I mean, they still have great value for regional trades, and we find very interested buyers. So they still have high value, even though they get close to 25 years. I think that's well shown in the sale that we just announced, that we are selling a vessel that was maybe bought for $50 million some 25 years ago, and now we're selling it at 17.5. I mean, that's a pretty good second-hand value for a 25-year-old ship. So they still have value, but maybe not so much for us. And we have 2 more that are around the same age, and they are likely to be sold within the year we have ahead of us. I think also in terms of overall emissions, the International Maritime Organization just announced their net zero framework. And that means that you could say traditional heavy fuel oil propelled vessels will be more costly to operate than, say, an ammonia propelled vessel by, you could say, mid next decade in the early 2030s. And that is important, you could say, for our strategic view on fleet renewal and so on. I think flexibility and efficiency are key, and that's why our new MGCs or our new building order, they just became a lot more competitive from the new regulation that will come into force here. So gradual fleet renewal, where we sell the older ones to better owners, and we develop and renew our fleets through new buildings that are flexible and ready for what comes in the next decade.
Matt, you've also been very active in the overall decarbonization landscape with a number of JVs and activities. Would you like to bring us up to speed with your broader involvement in that picture?
Yeah. I mean, we have a couple of exciting joint ventures. We have 1008, which is a joint venture to produce blue ammonia in Texas, and here we are working our way through the pre-feed stage. We haven't committed a lot of capital, but we do have an option to invest $100 million into the port infrastructure of that project. Quite similar in a way to what we have at Morgan's Point, only here it'll be blue ammonia. We think the prospect for blue ammonia just became a lot better with the IMO regulation that is about to come into place, because it means that blue ammonia, green ammonia will become competitive cost-wise with heavy fuel oil from within, you could say, the next 5 to 10 years. So we think that the offtake discussions we are having on that project will get a nice boost from this. And similarly, we are engaged in a couple of places in discussions around ammonia bunkering for shipping, and we look forward to developing those projects so that we can be part of that supply chain when the ammonia propelled ships are being delivered in the next year or two.
So the IMO regulations, as I understand, are expected to have an impact on fleet supply on one hand, and also on the cost differential operating the ships.
In a major way. I mean, it's going to double the cost of traditional heavy fuel oil in the early 30s. When you combine it with the EU ETS of Fuel EU Maritime, I mean, it's quite a significant impact, which will make the alternative fuels much more competitive. And it's not something that'll happen in a distant future. I mean, it'll start kicking in from, I mean, EU is already kicking in now, but the net zero framework is going to kick in from 28. So it's pretty soon when you're discussing a new building strategy and so on. So I think any shipping company now that is looking to renew the fleet through new building orders, they have to look at dual fuel with the flexibility at least to retrofit into to the new fuels.
And if I can add, there has been a discussion or a tendency, given the overall uncertainty, of doing nothing for a number of owners. As I understand, the do nothing option is not an option anymore.
I mean, if you have a mature fleet, I mean, you can do nothing and just sit it out and let that fleet get to the end of its lifetime, and you maybe even over the next 5 years or so make good money on that fleet. But if you have if you want to run a sustainable company that's also around in 10 and 20 years, you will have to renew your fleet gradually over time. And when you do such fleet renewal, no, you can't sit on the fence, because you cannot go out and order today a traditional heavy fuel propelled ship that cannot be retrofitted, because then you'll have a stranded asset in less than 10 years.
Well, I have to say on that front, I'm particularly grateful that when you join our forums around the world, you are very flexible, exactly being both on the market panel discussing about petrochemical gases, but also on the energy and the fleet renewal panel discussing exactly green shipping and all the fuel. So that's tremendous.
Yeah, no, I think it's really important strategically, and I think of course also at the same time that it's a great market opportunity for Navigator, because like ammonia, it will be transported on gas carriers. So once that market takes off, it's a tremendous market opportunity for Navigator.
Excellent. Let me turn now to the financial activities. You recently completed the 300 million refinancing and a 40 million bond tap. Can you tell us a little bit about the bond tap, which I find very interesting? Of course, the 300 million refinancing has been very, very interesting and very well received. How do you view your overall capital structure today, and how do you prioritize future liquidity deployment?
Yeah, our capital structure right now is strong. I mean, we have ample cash. We have no refinancing of any importance until 2029. We have interest cover over 5 times, and we have a net debt to EBITDA of 2.6 times. So by all parameters, we have a strong balance sheet. We were able to tap our bond right before the market closed with Liberation Day. It was a bond that we launched back in October at 7.25%, which was a record low margin for more than 10 years in the Norwegian bond market for shipping companies. It's unsecured, so we think it was a very attractive financing we got. And we decided to take another tap of 40 just in March. We have a total frame, you could say, of 200, so we still have about 60 million left if and when we decide to raise more cash from the bond. And then we also had the refinancing of the $300 million facility, which gives us 140 of fresh cash, you could say, to strengthen our balance sheet. We're very pleased with the support from 6 European banks in that aspect. It was in the middle of the trade war storm, but the banks were very solid. We got it all closed and signed on schedule at the right time without any wobbles, and we were able to secure the lowest margin that Navigator has ever secured for a bank loan. So we were super pleased with that. So when it comes to, you could say, overall future liquidity deployment, I'd say that it remains focused on gradually growing our shipping and infrastructure business. We'll be repaying our debt, we'll be paying dividends, and then also buying back shares. So I think that next in line when it comes to deploying liquidity, it is our share buybacks. So that is for now.
Well, that brings me exactly to the next question, the new 50 million buyback authorization you announced. So this 50 million share repurchase program is in addition to the existing return of capital policy. So can you take us through the existing policy and how the additional 50 million is in the overall strategic priority context?
I'd be happy to. I mean, the capital return policy has been in place for about 2 years now, and we are paying back 25% of our net income every quarter. From that, we pay 5 cents of cash dividend, and then between that 5 cents and up to 25% of net income, we can either pay additional dividends or we can do share buybacks. We have mainly done share buybacks. We thought that there's been great value for our investors in buying back shares when we're trading at a discount to our net asset value. So And then on top of that, we've done a couple of ad hoc, you could say, share buybacks. We did one back in 22 into 23, where we bought $50 million worth of. We did one again last year, just before the summer holidays, where we participated in the sell down from BW, and we took 50% of that. So I think it's been a good rhythm that we've had over the last couple of years, that we've done our quarterly cash and share buyback cash return. But then on top of that, we've also added an ad hoc share repurchase. I think it's worked really well, and we've been deploying the funds as quickly as practical. And so I think when it comes to how fast will we implement it, you probably need to look at what we did back in 23, with the difference here. I think that we right now we have more trading liquidity. We've had gradually increasing liquidity in our share over the past couple of years, and with that increased liquidity, it also allows us to do faster share buybacks.
Matt, actually, if you allow me to make the following comment, in a number of discussions we have been having at our forums and also with a number of CEOs like yourself, we always point out at the paradox of the valuation dislocation between shipping markets and the stock price of listed companies. And it makes no sense that you make all these investments, you have such a great infrastructure, and then companies several times trade below NAV. So having exactly this share buyback program in place shows your vote of confidence exactly in what you preach, in the value of your company and how it can benefit the shareholders.
Yeah, I think for us, it's about finding a balance, because we want to return capital to the shareholders with dividends and share buybacks. It's very important for any company, any good steward of capital, that there's a flow back to the shareholders. So we're strongly committed to that. And then, of course, we need to balance also that we want to operate this company in 5 years' time, in 10 years' time, in 20 years' time. So we have to develop, and we want to develop the company and grow and be stronger and be a good partner to our customers. And I think we are working real hard to find that right balance between stewarding capital back to the shareholders and at the same time developing our company so it becomes stronger and also ready for whatever the future brings.
To come into the last question, your strategic vision for the next 12 or 24 months, any particular, any top 2-3 priorities for Navigator as you look ahead for the rest of 2025 and possibly into 2026?
Yeah, I think maybe 3 things that I would mention here. One is to optimize the return on our core business. We want to work very hard on pushing up the rates that we are earning in the market and optimizing our fleet. And I guess this also includes that we will be selling older and low returning vessels so that we constantly have, you could say, a high performing portfolio of businesses. So that's one thing, optimizing the returns. Secondly, strengthen the shareholder returns. And that means both over time growing dividends and also buying back more shares than we've done in the past. Thirdly, then it is to prepare for the future. And that means also that we should take that full advantage of the upcoming global regulation on fuels and taking those opportunities that are right in front of Navigator. I think we are very well positioned for the transition that we have ahead of us, which will mean a lot more gases being transported on our ships.
Well, Matt, thank you. That brings us to the closing of our discussion. Thank you very much for joining us today, for sharing your insights on Navigator and also on the broader energy market. Thank you again. I'd like to mention that the full interview will be available on www.capitalinkwebinars.com and also on Capital Link's YouTube channel, and it will be available for replay upon demand. So thank you, and I look forward to our next discussion.
Thank you.